Hello everyone. Today is Chapter 7, Interest Rate and Bond Valuation. So first of all, we're going to give the definition of the bonds, the types, the ratings of the bonds. Then we'll talk about the yield curve. So first of all, what is a bond? So you can think of bond as a contract between the borrower and the lender. So in this contract, it's a legally binding contract. In this contract, we're going to have the following components. The first one is the face value or the principal value. Okay, so which is the payment at the end of the bond's life or at the maturity of the bond. Most of the time is the multiples of $1,000. Coupon rate, which is the annual interest payment. For example, if it's 5%, then 5% of the face value, $50, will be the coupon payment, which is right here, coupon payment. So the interest payment made to the bondholder. Maturity date is the expiration date. Some bonds have expiration date of 3 years, some have 30 years, some has even longer years. Yield to maturity, so the required market interest rate on the bond. You can think of yield to maturity as your total return if you hold the bond until the last day or on the expiration date. Okay, let's take a look at the bond cash flows. Well, suppose you purchased the bond in 2008. You pay a price, so negative price, okay? So negative price, you paid this price. Face value is $1,000. Suppose the coupon rate is 5%. 5% of $1,000, $50 is going to be the coupon payment. So what is coupon payment? The coupon payment is the periodic payments over the years of the bond's life. So in 2009, the first year, you received the first $50 coupon payment. Second year, another $50 coupon payment. Last year, the final $50 coupon payment, together with the face value payback. Okay, so how much are you willing to pay for the bond? Well, you need to calculate the present value of all future cash flows. In a bond, the future cash flows are the coupon payments in each period, plus the final face value. So if you like a formula, this is the general formula to calculate the bond price. And the R, which is the discount rate, or you can call it yield to maturity. So one thing I want you to pay attention is the coupon rate is not the discount rate. The coupon rate tells you what cash flow the bond will produce. In our previous example, 5% coupon rate means you will receive 5% times the face value $1,000, $50 coupon payment. Okay, so the coupon rate is listed as a percentage, but that is not discount rate. The discount rate is in the discount, right? It's the R or the yield to maturity to calculate the present value, while the coupon rate is the rate to determine the coupon payment in each period. Okay, so the primary principle is the value of any financial security is going to be the present value of the expected future cash flows. So for the bond, it is determined by the present value of all coupon payments and in the terminal period, the par value payback. Okay, so the interest rates are inversely related to the present value of the bond, because if you go back to the formula right here, present value and the discount rate are negatively related to each other because the discount rate is in the denominator. Okay, so let's take a look at the following example. I want to use this example a couple of times with some modifications in this chapter, so please pay attention. What is the price of a 5.5% annual coupon bond? Annual coupon bond means the coupons are paid on the annual basis at the end of the year. Face value $1,000. Maturity 3 years, means the bond will last for 3 years. Assume a required rate of return of 3.5%. Okay, so we have two percentage rates here. 5.5 is the coupon rate, which determines the coupon value, which is 5.5% times the face value, that is $55. You will receive $55 annually. All the coupon payments and $1,000 face value will be discounted at 3.5 discount rate. Okay, so the present value or the price of the bond will be all the future cash flows discounted back to time zero. So in the first year, you'll receive $55 coupon payment, discounted at 1 plus 3.5% to the power of 1 year. In the second year, you'll receive another $55, discounted at 1 plus 3.5% to the power of 2 years. Finally, the terminal year, you'll receive the last $55 coupon payment, plus $1,000 face value, discounted at 1 plus 3.5% to the power of 3 years. So the maximum amount of money you're willing to pay for the bond is $10.56. If you want to use the calculator to calculate the bond price, this is what we do. Number of period, 3 years. Yield, 3.5%. Again, we drop the percentage sign in the calculator input. Payment, each year, $1,000 times 5.5%, $55. Future value, or the face value that will be paid at the end of the maturity, $1,000. Compute. The present value of the bond will be $10.56, exactly the same number as we calculated in the previous slides. But the calculator will report a negative sign as usual because this is a payment. You paid this amount to receive the $55 coupon payments, to receive the $1,000 face value at the end. Okay, so now I want to change the previous example a little bit. What is the price of the bond if the discount rate increased from 3.5 to 5.5%, right? In the first example, the discount rate is 3.5%, but now we increase it to 5.5%. What happened to the bond price? Let's see. So the bond price will be, again, the structure of the cash flows are exactly the same. But instead of using 3.5%, we're using 5.5% in the denominator. We calculate the bond price, which is exactly $1,000. Okay, we're going to look at another example, and then I'm going to tell you why the bond price dropped comparing to the first case. Right, so the third case is, now the rate of return increased to 15%, right? In the previous slides, we have 5.5, but now we have 15. What is the price of the bond, all else equal? Okay, again, instead of using the 3.5 or the 5.5%, now we're using 15%. The structure of the cash flow payments are exactly the same. Now the price of the bond is $783 only. Okay, so let me pause here. Think about why, when the rate of return increased from 3.5 to 5.5 to 15%, the price of the bond continues to drop and drop. Think about that. Pause the video here. Think about that. Well, the reason is, first of all, there is an inverse relationship between the present value and the discount rates, right? It's obviously from the formula. But if you want to understand the logics behind it, okay, we go back from the first example. When you buy a bond, the bond pays you 5.5% coupon rate, which is higher than your required rate of return 3.5%, right? Okay, which means if you do not buy this bond, you can only get 3.5% return from some other investments. So the 3.5% return is the prevailing market rate, or it is your opportunity cost. 5.5% is higher than what you expected or you required. So that is why you are willing to pay more than face value, right? So $1,000 is the face value. You are paying $56 premium to get this bond because the coupon payment annually is higher than you expected. So 5.5% is higher than 3.5%. That is why you are willing to pay a $56 premium for this $1,000 bond. Well, in the second case, the coupon payment and discount rate or your opportunity cost is exactly the same, 5.5%. So there is no premium or discount at all. If the coupon rate is the same as your discount rate or your opportunity cost, the maximum amount you are willing to pay for the bond is just the face value, $1,000. In the last case, the coupon is 5.5%, while the required rate of return or your opportunity cost is 15%. Means if you don't buy this bond, you can buy something else and getting 15% return. To compensate for the lower coupon payment, so 5.5 is a lot lower than 15%, right? So to compensate for the lower return, you have a huge discount from the face value, $1,000. You're only paying $783 to buy this bond. You're getting a discount. Okay, so basically let me summarize. When the coupon rate is the discount rate or the yield to maturity, price of the bond is the par value, $1,000. When the coupon rate is higher than the discount rate or the yield to maturity, the price is higher than the coupon value. That is called a premium bond, which is our first case when you calculate the bond price is $10.56, which is higher than $1,000 par value. That is a premium bond. While when the coupon rate is lower than the discount rate or the yield to maturity, which is our last case, coupon rate 5.5%, discount rate is 15%. So the price is going to be lower than the par value, $1,000. Our price is $783, right? So that is a discount from the face value. Okay, so let's plot the bond price or the bond value on the vertical line, and on the horizontal line we have the discount rates. And then let's see what happens. When the discount rate or the yield to maturity is 5.5%, you see the value of the bond is exactly $1,000. When the discount rate is lower than 5.5%, that is a premium bond, so the price of the bond is higher than $1,000. When the discount rate is higher than 5.5%, in this range, the price of the bond will drop below $1,000. Okay, so our example continues. Now, what is the price of the bond if the required rate of return is 3.5%? So that's when we go back to the first example, right? The discount rate is back to 3.5%. Well, now the coupons are paid semi-annually, means every 6 months. twice a year. Well, then it becomes a little bit tricky because 5.5% coupon payment means each year you receive $55 coupon. But the coupons are paid every 6 months, twice a year, which means you cut the $55 coupon payment in half, $27.5. Every 6 months, you receive $27.5. Okay? So in 3 years, remember this bond has a maturity of 3 years. How many 6 months we have in 3 years? 6 months, right? Each year we have 2 6 months. Okay. So discount rate is 3.5%. So what is the discount rate in 6 months? Because whenever we report an interest rate, that is an annualized number without any specification, okay? If I didn't say anything about this rate, you can safely assume it is an annual rate. But now we're talking about semi-annual, every 6 months. So we have to cut the discount rate in by 2 as well. So 3.5 divided by 2, 1.75% every 6 months. That is the interest rate. Okay. So now the present value or the bond price will be expressed in the following terms. In the first 6 months, you receive 27.5 coupon payment, discounted at 1.75%. This pattern goes on until the last 6 months. You're going to receive a $1,000 face value plus the last $27.5 coupon payment. Okay, so now it's going to be discounted 6 periods from now. The present value is $1056.49. Okay, so now I want you to pause the video again and think about this price. The price is $1056.49. Comparing to the first case, if you go back here, when the bond is paid annually, all numbers are exactly the same, okay? The only difference is in our first example, the coupon payments are paid on the annual basis. The price is $1056.03. But here, when it's paid semi-annually, the present value is $1056.49, which is 46 cents more expensive. Why is that? Well, the answer is, now you receive the coupon payments on the 6-month basis. Before, at the end of the year, say December, you'll receive $55. But now, you receive half of the payment in June and another half in December, which means each year you're receiving half of the money sooner than the annual coupon payment bond, which means you are willing to pay a little bit more to receive the coupon payment faster. Because remember, money has time value. When you receive the $27.5 coupon payment in June, you can start investing it in the bank or somewhere else to earn interest. So that is why the price of the semi-annual coupon payment bond is always going to be higher than the annual coupon bonds, if all else equal. Now, if you want to use the calculator to calculate the value of the bond, all you need to do is making sure everything is in the unit of month. Okay, 3 years means 6 months. Okay, yield 3.5 divided by 2. Every 6 months, you're discounted at 1.7%. Coupon payment. Instead of $55 each year, now you are only getting half of it, $27.5 every 6 months. Okay, future value or the face value is $1,000. Then you compute 1056.49, which is exactly the same number as we calculated in the previous slides. Negative sign means that is a payment, cash outflow. Okay. So how did the calculation change given the semi-annual coupons versus the annual coupon payments? Let's summarize. It's very important because in the real life, most of the bonds are paid semi-annually. So first of all, time periods. Because now you're receiving the coupon payments twice a year, so the total time period will double. Discount rate. Now we're looking at half years, so the discount rate will be cut in half. Okay, so now I want to introduce the bond yields. The first one is called current yield. So the annual coupon payments divided by the bond price. Okay, like for example, 10% coupon bond, semi-annual payment, face value $1,000, 20 years to maturity. Currently, the bond is selling at $11.97. Okay, so the current yield will be the coupon payment, which is 10% times the face value, $100, divided by the current price of the bond. So the current yield will be changing all the time because the price of the bond is changing all the time. Okay, all right. 8.35%. Yield to maturity. What is yield to maturity? If you look at this present value formula, R in the formula, the yield to maturity. Okay, so this R, the discount rate, is the yield to maturity. That is the definition for the yield to maturity, which is the interest rate for which the present value of the bond of the bond's payments equal the price. Okay. So consider a bond, 10% annual coupon rate, 15 years to maturity, par value $1,000, current price $928. So what is the yield? So first of all, think about whether the yield is higher or lower than 10%. Recall the definition of premium bond and discount bond. Pause the video here and think about this. Okay. The yield is going to be higher than 10%. So before you hit the calculator and do the calculation, you know the yield is going to be higher than 10%. Why? Because this is a discount bond, right? The definition of the discount bond is coupon rate lower than the discount rate. So that is why you get a compensation, right? Which is a discount from the face value. So to use the calculator, you input 15 as the number of periods, present value or the price, which is a negative number, $928. Future value or the face value is $1,000. Coupon payment $100. Then you compute. The yield is 11%. Okay. So another example. Now we have the semi-annual coupon payments. Again, 10% coupon rate. Face $1,000. 20 years maturity. Now it's selling at a premium $11.97. Okay, so first of all, you think about whether the yield to maturity is higher or lower than 10% before you're actually calculating it. Well, it's going to be lower, right? Because it's a premium bond. The definition of the premium bond is the coupon rate is higher than the discount rate. So that is why you are willing to pay a premium or more than the face value. Okay, But now the tricky part is semi-annual coupon payment. Means you have to adjust all the numbers in the units of every 6 months. 20 years means 46 month periods. Present value again is the price of the bond. It's a negative number because it's a cash payment. Coupon rate. Instead of receiving $100 coupon at the end of the year, you're only receiving half of it every 6 months. Future value, or the face value, is again $1,000. Compute the yield. Well, the calculator will report 4%. But think about this. Is it 4%? No, really, because the 4% is calculated in the unit of 6 months. But to report the rates, to report the yields, we always have to report the annualized number, which is 8%. 4% times 2, okay, 8%. Okay, so now let's talk about the types of bonds. Broadly speaking, we have 3 types of bonds. They are different because they have different issuers. The first type of bond is called a government bond or federal government bond. They are called treasury bonds. They are issued by the federal government agencies. The second type of bond is called municipal bonds. They are issued by the municipal governments. There are 2 types of municipal government bonds. One is called general obligation bond. The other is called revenue bonds. Okay, so the general obligation bonds means all the payments, the coupon payments and face value payment are backed by the taxing power of the government. While the revenue bonds, the payment of the coupon and the face values depends on the actual profits made through the projects. Let me give you an example. Now suppose you want to build a hospital in New York, a new hospital. Then the New York government can issue municipal bonds to borrow money from the general public. If they build the hospital and issue the bonds using the general obligation method, which means even if the hospital is not profitable, is in loss all the time, the government will make sure you still get the coupon payments and the face value paid back by using the taxing power, which means the government can collect the personal tax, corporate tax, and all sorts of tax from the residents of the New Yorkers, right? They are going to use the tax dollars collected to pay the coupon payments and the face value of the bondholders. So this is very safe. Well, if the hospital is financed by issuing revenue bonds, then whether you can receive the coupon payments or and the face values depends on whether the hospital can generate enough profits. If the hospital does not generate any cash flow, no profits at all, you will not receive any coupon payments or the face value payback. The last type of bond is called corporate bonds. Well, they are issued by corporations. When the corporate bonds are issued, they can either go public or private placement. Public means the bonds are issued to all general public. Anyone can buy it. Private placement means they are talking to the private investors, a couple of big institutional investors or extremely wealthy people, to do it privately, to privately sell the bonds to a couple of institutional holders or extremely wealthy people. Corporate bonds can be collateralized or unsecured. Collateralized means they have properties as collateral. Unsecured means there are no collateral. For example, if a hotel wants to issue corporate bonds, they can use the hotel building as the collateral. Means if they fail to pay the coupon payments or the face value to the investors can sue the hotel and force the hotel to sell the building because the building is a collateral, to sell the building to generate enough cash flow to pay back the investors. While the unsecured bonds means there are no collateral. Okay? Means if the same hotel, if they fail to pay the coupon payments, if the bonds are unsecured bonds without any collaterals, the investors cannot force the hotel to sell the assets, to sell the buildings itself to make the payments. Okay, so let's talk about the government bond first. Means the treasury securities. They are issued by the federal government. So the treasury securities have three different subcategories: T-bills, T-bonds, T-notes, and T-bonds. The differences among the three are the maturity. T-bills are the pure discount bonds with the maturity less than 1 year. T-notes or the treasury notes within 10 years maturity, between 1 and 10 years. T-bonds most of the time greater than 10 years maturity. Okay. So zero coupon bonds. Zero coupon bonds means there are no coupon payments. The coupon rate is 0%. So the entire return or the yield to maturity comes from the difference between your purchase price and the par value, face value. That is why all zero coupon bonds are called discount bond. Because there are no coupon payments, you have to make your money or make your profits from the discount. So you cannot sell them for more than the par value. Nobody will buy it. Sometimes they are called zeros, deep discount bond, or original issue discount bonds. Treasury bills are the good examples of zeros. So the pure discount bond means there are no coupon payments in between. The only cash flow is the face value payback at the end of the maturity. So the price or the present value of the pure discount bond will just be the discount value of the face, which is F divided by 1 plus discount rate to the power of T periods. Here is an example: 15-year zero coupon bond, face value $1,000, yield to maturity 12%, paid annually. So the price of this bond is just the discount value of the $1,000. 1,000 divided by 1 plus 12% to the power of 15 years. So the bond is only worth about $183. The municipal bonds, or the municipal securities, they are the debt issued by the state and the local governments. The default risk depends on which local government issues the bond. So they are rated similar to the corporate debt. There will be a rating system telling you which one has higher default risk, which one has lower default risk. We're going to talk about the ratings later in the corporate bonds. One important feature for the municipal bond is the interest you receive is tax-free at the federal level. Means you can keep it 100% tax-free at the federal level. Let's take a look. A taxable bond has a yield of 8%. A municipal bond has a yield of 6%. If your personal tax rate is 40%, which bond do you prefer? Well, the taxable bond means although it offers you 8% rate, but you cannot get it. You have to pay tax. You can only get the after-tax portion of the 8%. While the municipal bond, you can get it tax-free. So first of all, you need to calculate if you purchase the taxable bond, what is the after-tax return you get? So 8% times 1 minus 40% tax rate equals 48%. So that is your after-tax return on the taxable bond. While comparing to the 6% return on the municipal bond, which is tax-free, you will prefer the municipal bond. Okay. The question is, different people will have different preferences, because if your tax rate is 40%, while some people have a lot lower tax rates. For example, if you're a student, your tax rate is very low, like say 20%, right? If you are in the 20% personal tax rate, which means 8% times 1 minus 20%, so 8% times 80%. So you can get 6.4% after tax, which is actually better, right, than the municipal bond. So you will prefer the taxable bond as a student because your tax rate is pretty low. So the question is, at what tax rate you will be indifferent between the two? Means both of them look equally good to you. So the calculation is very simple. 8% times 1 minus the tax rate equals 6%. Let's back out the tax amount, 25%. So at a 25% tax rate, you will be equally happy with either bonds. If your tax rate is below 25%, you prefer the taxable bond. If your tax rate is higher than 25%, you prefer the municipal bond. Okay? So next, we're going to talk about the corporate bonds. Corporate bonds, the major problem with the corporate bond is the default risk relatively to the government bonds, because they are not issued by the governments. They are issued by the private companies, corporations. So if the corporations is out of business, they will not be able to pay all the coupon payments and the principals. So they have to pay you a higher yield or higher return or higher yield to maturity because this added default risk comparing to the government bond. Okay. Because the major concern of the corporate bond is the safety or the default risk, we have a lot of bond rating agencies rate the bond's default risk. The most famous ones are the Moody's and the Standard & Poor's. So they're going to give each corporate bond a rating. So the highest rating is AAA. If the bond has a AAA rating, it has the strongest rating, means the ability to repay the interest and the principal is very strong. Second grade is AA. It's very strong in terms of financial ability to pay the interest and the principal. And then we move on to single A, triple B, double B, single B, etc. and etc. Okay, the cutoff here is triple B. Triple B and above are investment grade. So those four are investment grade. If you want to do an investment, you want to look at triple B and above corporate bonds. But if you want to do a speculation, you want to try your luck, and you want to get some very high yield bond, triple B below, so double B and below, those are speculative bonds, or sometimes we call them high yield bond. Okay, so high grade bonds, mostly AAA, AA, those are considered to be relatively safe. Medium grade A and triple B, okay, those are considered okay. Low grade are the ones below triple B, and a very, very low grade like C and D. Okay. Why the rating is so important? Because the safer the bond, the lower the yield. The lower the rating, like triple C, which is very low rating, means the risk is very high. The default risk is very high. You have to offer a higher yield to investors to attract investment. So let's take a look. Over the period, a double A, the blue one, offers the blue yield, which is in the recent years, which is in the range of 2 to 4% in recent years. Okay. The black one is the triple B, which is 2 grades later, lower, 2 grades later, because after double A you have single A, and then you have the triple B. While triple B, because the rating is lower than double A, triple B rated bonds have to pay you a return in the range of 4 to 5% to attract any investments in recent years. And then let's look at the high yield or the junk yield or the junk bond, high yield bonds. They have to offer you on average 6 to 8% return to attract any investments in recent years. In the financial crisis area, remember in 2008 and 2009, we have the housing bubble burst. In the crisis time, people will more likely to put money in the safer bond instead of putting money in the high yield or the junk bond. Okay? So in the financial crisis period, all rated bonds will offer you higher return because, they still have some risk of go bankrupt. But you see, the high yield or the junk bond have to offer you as high as 20% to attract investment, while the double A offers on average about 8%. Investors will be happy to invest. So rating is very important. The higher the rating, the lower the financing cost to the company. So the company are always trying to maintain a very good rating, because if the rating is good, they do not have to offer a very high return to the investors. Inflation and interest rates. All the interest rate we were talking about, nominal interest rates, means we did not consider inflation at all. But here we want to introduce the idea of real interest rate, which is change in purchasing power. Nominal interest rate is our quoted rates. So whenever I report the rates, that is the nominal interest rate, real interest rate has to be computed by yourself in this formula. So 1 plus R, nominal interest rate, equals 1 plus lowercase r, real interest rate, times 1 plus H, the expected inflation rate. That is our famous Fisher's equation. If you think this is complicated formula or cannot calculate the number immediately, you can always use the approximation formula. Nominal interest rate equals, or roughly equals, real interest rate plus expected inflation. Here is an example of the Fisher's effect. 5% real return, 2% inflation. What is the nominal rate? You can use the Fisher's equation, 1 plus 5% real rate times 1 plus 2% inflation minus 1, you have 7.1 nominal rates. You can also use the approximation formula, which is 5% plus 2%, 7%. So the approximation is pretty good. Inflation-linked bonds. Most government bonds will face inflation risk. For example, if you purchase a government bond for 30 years, each year you receive $1,000 coupon payment. Well, you may buy a lot of goods using $1,000 today, but in 30 years, you may not buy the same amount of goods anymore, thinking about inflation, right? Now we have inflation-protected bonds. It's called TIPS, Treasury Inflation-Protected Securities. The coupon payments are paid in real terms instead of nominal terms. For example, you have a face value of $1,000 in TIPS, coupon payment 1%, which means you receive $10 each year. If the inflation goes up by 2%, so the next year, instead of getting $10, you will get 2% more, $10.20. If the expected inflation was negative, falling 5%, for example, instead of getting $10, you will get $9.50 over the year. Finally, we want to talk about the term structure of interest rates. The term structure of interest rates is the relationship between nominal interest rates and the time to maturity. The nominal interest rates are referred to the rates on default-free pure discount securities. Default-free really means the government-issued bonds, pure discount bonds. Okay? So the yield curve can take any shape. We have the normal yield shape, which is upward sloping, which means long-term yields are higher than short-term yields. Well, we could also have inverted or downward sloping yield curve, means the long-term yields are lower than the short-term yields. Okay? So the yield curve is the representation of the term structure. It can take any shape, could be upward sloping, could be downward sloping. So let's take a look. For the upward sloping yield curve, all the yield curve has three components. The first one is the real rates, which is a constant number. Then the second component is the inflation premium. Most of the time, people will think, oh, inflation will always increase in the future. There will always be some inflation. So the longer the maturity, the higher the inflation premium people required. So the inflation premium is an upward sloping curve. The third component of the yield curve is interest rate risk premium. The longer the maturity, the higher the uncertainty, so people will require a higher interest rate to compensate for the uncertainty. That is why this is also an upward sloping curve for the interest rate risk premium. So add all the three components together, the overall yield curve is upward sloping. If we have a downward sloping term structure, it means, again, we have three components. The real rate is constant number. People's expectation about inflation is actually going down for the long-term bond. So the longer the period, they think the inflation in the future will be actually lower. The interest rate sloping is actually still higher for longer maturity bonds, because the longer the maturity, the more uncertainty the bonds will have. So the downward sloping is mainly due to the inflation expectation. So in the following slides, I'm going to summarize what we have seen from the picture. The major three components of the yield curves are the real rates of interest rate, inflation, and interest rate premium. The real rate of inflation, as shown in the picture, is a flat number. People's expectation of the inflation are the major factor to determine the shape of the term structure, whether it is upward or downward sloping. Interest rate premium, most of the time the longer term bonds will have a higher risk, more uncertainty. That is why people will have a higher interest rate given to the long-term bonds. There are some other factors also affecting the required rates of return. The first one is the default risk. Remember the bond ratings, the higher the rating, the lower the rates. The lower the rating, you have to give investor higher rates to attract investors. The second factor is tax. Remember the municipal bonds versus the taxable bonds? The municipal bonds can pay a lower return because they are tax-free, while the taxable corporate bonds, they have to give you a higher return because you have to pay tax on them. Another factor to consider is the liquidity premium. If the bond has very high liquidity, means they have very frequent trading, you can buy and sell those bonds very easily by clicking your mouse. Comparing to the bonds with low liquidity means there are not many tradings and it's very hard to buy and sell your bonds. The bonds with high liquidities will have lower required rates of return than the low liquidity bonds.